So, you want to learn bookkeeping? By Dave Marshall. http://www.dwmbeancounter.com. Aging reports. Accounts receivable aging report. What is it and what does it show us? An accounts receivable aging report or schedule is a report that lists all of the amounts that your customers owe you and groups the amounts owed into categories that show if the amounts customers owe are current or past due. What affects the timing of your collections? What's a major factor that might affect the time that it takes to collect your sales? This is not a difficult question. The credit terms that you grant your customers affect when your sales will be converted into cash, collected. Common sense tells you that the longer the period of time that you allow your customers to pay you, the longer it will take to get your cash. On the flip side of the coin, if all your sales were cash sales, you would have your cash at the time of the sale. Another is the credit worthiness of your customers. What does it tell or do for us? It helps or tells us, are our customers paying on time? Used in aid in estimating bad debts. Determine what customers we need to send a reminder notice and/or statements of past due invoices. Determine what customers that we may have to change their payment terms. Determine what customers we need to call. Helps determine when we can expect to receive cash from our customers. Used as an aid in preparing budgets and projections. Is it tough to prepare? It is tedious and time-consuming to prepare using a manual bookkeeping system. It requires a detailed analysis of customers' unpaid invoices. Using a computer bookkeeping program, it's a piece of cake. Just push a button and get a report when needed or wanted. Accounts payable aging report. What is it and what does it show us? An accounts payable aging report or schedule is a report that lists all of the amounts that you owe to your suppliers and groups the amounts owed into categories that show if the amounts you owe to suppliers are current or past due. What affects the timing of your payments? What's a major factor that might affect the time that it takes to pay for your purchases? This is not a difficult question. The credit terms that your suppliers grant you affect when your purchases need to be paid. Common sense tells you that the longer the period of time that your suppliers allow you to pay you, the longer you can take to pay them. What does it tell or do for us? It helps or tells us, are we paying our suppliers on time? Helps determine when we need to have cash available to pay our suppliers. Used as an aid in preparing budgets and projections. Provides a warning that some suppliers may change our payment terms. Is it tough to prepare? It is tedious and time-consuming to prepare using a manual bookkeeping system. It requires a detailed analysis of suppliers' unpaid invoices. Using a computer bookkeeping program, it's a piece of cake. Just push a button and get a report when needed or wanted. Cash forecasting. Does my praying cartoon buddy illustrate how you manage your cash? Don't get me wrong, a little praying can't hurt. But, you also need to do some planning on your own. Many of the small businesses that I have been around don't make use of a simple tool, the cash forecast, that can provide them with some restful instead of sleepless nights worrying about bills. I really don't know why, because a cash forecast is not that difficult to prepare once you know how. Cash is a business's most precious asset. Managing cash flow is one of the most important tasks every top manager and business owner must be able to understand. Believe it or not, many businesses have had to shut their doors not because they weren't making a profit, but because they weren't managing and controlling their cash. Profits and cash flow are both critical elements needed for a business to survive and be successful. Good cash management is also just as important as making a profit. Great cash management is even better. Good projections and accounting records are important tools for the success of a small business. While outside accountants are sometimes necessary to help, you can save some money by producing your own projections. What is a cash forecast? A cash forecast is simply a tool that a business uses to plan. How much and when is money coming in and from where, source? How much and when is money going out and for what types of payments? In other words, a cash forecast is just an estimate of your business's cash inflows and outflows over a certain period of time. Cash coming in is called a cash receipt and cash going out is called a cash disbursement. If cash receipts are greater than cash disbursements during a period, the business has what is called a positive cash flow. On the other hand, if cash disbursements are greater than cash receipts during the period, the business has what is called a negative cash flow. A cash forecast identifies when cash is expected to be received and where this cash will come from, source, and also when it must be spent to pay bills and debts and what the payments are made for. Creating a cash forecast requires you to make reasonable estimates about what will happen in the future. In order to help predict the future, historical data when available is used and modified to reflect future expectations. Cash forecasting and planning requires experience and judgment in order to determine such items as expected sales, purchases, and operating expenses. A cash flow forecast or budget can be prepared for any period of time, a day, week, month, year, or even many years into the future. I recommend that you at least prepare a one-year budget by month. It should be reviewed and revised periodically to reflect actual performance and any changes in plans. By using this tool and analyzing your projections, you can see the fluctuations in cash flow and take corrective actions to avoid potential shortfalls. I'm amazed at how many small businesses don't take advantage of this simple tool that I consider one of the most valuable tools management has for monitoring, controlling, and changing the day-to-day operation of a business. Are you one of them? Where do you think most of the cash a business receives comes from? Now, this is no trick question. Of course, it comes from the sales of products and/or services that the business bills its customers. When does the business receive this cash? It depends on your type of business and what credit terms that you need to offer to your customers. For example, if you give your customers 30-day terms, you have to wait 30 days in order to collect your money. On the other hand, if most of your sales are cash or counter sales, you receive your cash at the time of the sale. On what do you think a business spends a good portion of its cash? Let's list a few of the biggies. Purchases of products for wholesale and retail types of businesses that sell products. Payroll and fringe benefits. Manufacturing costs for businesses that make and sell products. Federal and state taxes and licenses. When does the business have to pay for these type of expenditures? When a business pays its employees depends on the payroll policies that the business has set up. Nowadays, due to the use of computers and payroll software, it's a fairly common practice for businesses to pay their employees each week. In the case of purchases, it depends on the credit terms that suppliers have granted to the business. One of the worst cases is COD, which stands for cash on delivery. This means the business has to immediately pay for the purchases when they receive the goods. If the business has been granted more liberal terms such as 30-day terms, they can wait 30 days before they have to pay for the goods that they purchased. When the payments for taxes and licenses are required as regulated and set by the states and federal government. What's involved in preparing a cash forecast? There are 5 basic steps to creating a cash flow projection. Gather up your historical financial information, develop and state your assumptions, and select the time periods covered. Estimate sales and their collections for the time periods you want to cover by period. Identify and estimate amounts and the period collected for other sources of cash. Identify and estimate amounts for all items that you have to pay for and when, period. Enter and formally summarize information on worksheets. Why do you need a cash forecast? The answer to this question is simply to ensure that you have enough cash on hand to pay your bills, employees, and notes when they become due and obtain any needed equipment. The forecast helps you identify potential shortages of cash and allows you to take actions to correct the problem before it occurs. The day you run payroll and don't have the cash to cover it is not the best time to try and find a solution. How does a cash forecast benefit you? Forecasting allows you to plan for, identify, and take action in the following areas. Identify business or seasonal fluctuations, peaks and valleys in your sales. Ensure that cash is available to handle employees' payroll. Ability to foresee and handle note repayments. Ability to foresee, handle and make timely payments to suppliers. Be alerted to short-term borrowing needs. Plan for long-term financing needs. Additional benefits. Plan for reducing your outstanding loan balances. Plan for needed equipment purchases, capital expenditures. Take advantage of supplier early payment discounts. Plan inventory levels and related purchases. Monitor customer payments and revise customer credit policies and terms if needed. Determine what to do with excess cash if you're fortunate enough to have this problem. In other words, how much you have that you can invest and increase your earnings. What are your forecast period options? Your choices are short-term, 1 week to 1 month. You could if you wanted to even forecast 1 day. Medium-term, 1 month to 1 year. Long-term, 1 year or longer. Note the shorter the time frame, the better your estimate should be. In other words, it's easier to predict what will happen next month than it is to predict what will occur 5 years from now. Budgets. What is a budget? A budget is an estimate of future revenues, costs, and expenses for a specified future period of time. It is used to compare planned results with actual results. Static versus flexible budgets. There are two major types of budgets, namely static and flexible. A static budget does not change over the life of the budget. Regardless of changes that occur during the budgeting period, all accounts and figures originally calculated remain the same. A flexible budget is related to business activity such as an increase or decrease in sales or production levels. Both types of budgets are useful for management. A static budget evaluates the effectiveness of the original budgeting process, while a flexible budget matches adjusted budgeted amounts with actual results. Where do you start? The process begins by establishing assumptions and estimates for the upcoming budget period. The sales budget is often the first to be developed because many costs and expenses, variable costs, are related to the level activity. Mini-budgets are often developed and summarized in an operating budget. An operating budget shows a business's estimated revenue and the expenses for a specific period of time. It's very similar to a profit and loss report. What period should you use? You should prepare a budget for a year and in addition break it down into months. Why months? Monthly comparisons allow you to see if your plans are on course throughout the entire year. Where do you get the amounts? Analysis of financial statements to aid in determining past experience and trends as a starting point adjusted for any future plans. What's involved in preparing a budget? Sorry, we don't have a crystal ball to predict the future. Preparing a budget does require some time and effort. Gather up and analyze your historical financial information, develop and state your assumptions, and select the time periods covered. Estimate sales and other revenues. Identify and estimate amounts for your costs and expenses. Enter and formally summarize information on worksheets. Is there a tool to aid in preparing budgets? Many businesses use Excel spreadsheets as an aid in preparing their budgets. This is an excellent tool if you find or make one, if you're familiar with Excel. That does more than allowing you to input the information and just set it up. The example I presented earlier is an example of such a simplified spreadsheet. The good spreadsheets as well as some accounting software allow you to input your prior financial information and use formulas to prepare the budget for you. Conclusion: like a game plan for a sports team, a budget is a plan for your business. It helps you to determine what's doing well and what's not doing so well.